So give us the first setup here after last week's break and some weaker euro numbers from Germany, but some consistency here in the U.S. Where are we sitting on this kind of potential bottoming for the global economy? Is it now hope as opposed to real after this bad number last week, or what?
Yeah, so I think the big data point over the weekend in that respect was data from Chinese PMIs. We had both the official sector PMI and the market PMI. The market PMI was arguably a bit stronger than the official one, but the underlying details of the official sector survey for manufacturing in China showed an ongoing sort of stabilization process and maybe even bounce with respect to new export orders. As long as the trade war is hanging over China, those aren't going to get anywhere too frothy. But we have seen, at the very least, over the last 6 months in both Chinese data and other data points in the region, stabilization relative to where things stood in late 2018, early 2019, where activity was really falling off the edge. As far as the U.S. goes, we got a pretty big data set tomorrow. Today, we've just got a couple of manufacturing indices from the Chicago regional activity related to manufacturing. And then we also have the Dallas Fed manufacturing activity index later today. Tomorrow is the big one with markets, final reading for September for their manufacturing PMI, ISM's PMI, construction spending, and of course auto sales from Ward's Auto as they're tracking new vehicle sales in the U.S. So looking for new vehicle sales to continue running at a decent pace, sign of that strong consumption from the middle of the year, bouncing back from a weak Q1 and Q4 last year to continue. And with respect to the U.S. manufacturing sector, just seeing signs of stabilization. That's what we really want. One point with the manufacturing sector in the U.S., we've seen a very big divergence between ISM and the regional manufacturing indices from the various Federal Reserves around the country. We have a measure that averages the 5 of those regional manufacturing indices, and that average suggests that manufacturing is actually expanding at a slow but respectable pace, whereas ISM, which tends to be more correlated to what's going on in headlines and the financial markets, has been much weaker. So looking for that to resolve.
So George, with the continuing U.S. data here that's been beating the expectations, right? The economic surprise index, turned positive, then it just kind of took off. As we were talking about here at the top of the show, obviously the Eurozone one is going in the opposite direction. But your point about China, I think this is really interesting that you've got this potential kind of bottoming or stability, at least in some of their manufacturing numbers. What's more important to this idea of a possible, stabilization of the global economy? Is it decent numbers from China and stabilization there, or continuing worsening out of the core of Germany and the Eurozone? Which one's more important to figuring out the direction here?
Well, I think they're related. And the interesting thing with Germany is that if you look at the aggregate statistics for the economy as a whole or specific volume in manufacturing, it looks very different from more sentiment-driven indices like new orders or the PMIs. So if you look at PMIs, it looks like Germany is in a flat-out recession, but they just had unemployment claims drop by 10,000 in August, and they're down over the last 4 months. So things are clearly not as bad as what the manufacturing sentiment indices indicate. And you can also look at French data. Again, in France, manufacturing looks to be in pretty good shape. It can only be so bad in Germany if French manufacturing is doing okay, right? So I think it's really interesting that we've seen so much focus on the implications of the trade war, on China's slowdown, on Turkey, what has driven this massive decline in sentiment in Germany, when other cross-checks that you can do with that data, whether it's the employment data from Germany, whether it's German services PMI, whether it's French data and for their manufacturing data, whether it's German exports, all of those suggest that, yeah, things have definitely slowed in Germany, but we are not having some sort of catastrophic decline in activity. So, I think the German story is highly idiosyncratic and highly sentiment-driven in a way that isn't true for instance, what's going on in China.
Okay, so back to the PMI chart then. To your point here, I mean, even if this is happening while you've got tensions still existing between the U.S. and China last week, all the headlines, not a lot of follow through on the nature of limited investment in China. We don't really know where that's going. But the fact that this is potentially trying to find a rebound, even despite the intensity of the rhetoric, what happens if there is some potential, resolution or steps towards that? I mean, is there a coiled spring here with China ready to bounce if this is happening already?
So China's got two basic problems. The first problem is the trade war, and we can come back to that because I think most viewers are probably pretty familiar with what's
Sure.
going on there. The second problem is, more generally speaking, the backdrop in China is one of slowing growth because the drivers of growth are starting to peter out. Their demographics are shifting against them very hard, as they have in the last couple of years. That's going to become a persistent headwind. They've picked most of the low-hanging fruit when it comes to urbanization. The incremental growth or incremental number of people they need to move from rural areas into cities to generate the sort of activity boost that they saw from 2005 roughly through the 2015, call it, that 10-year period. They're having a harder time doing that because the base effect is so much larger, right? The economy has grown so much that adding incremental people into that urbanization system is less and less helpful. On top of that, property prices are dramatically higher now than they were when this whole process kicked off, whether you're in a tier 1 city or a tier 3 city or anywhere in between. It's just much, much harder to get people into apartments, into factories, into an urban environment. So that's the long-term story, and that has nothing to do with the trade war, and that's going to be a headwind for Chinese growth for the next generation. There's literally nothing that can be done about that from a cyclical perspective, on top of high debt that already exists. Now, coming back to the trade war situation, I don't think there's ever going to be a clean resolution between the Trump administration and China. I think playing for that just doesn't really understand the motivation behind why the Trump administration has pursued a sort of pugilistic approach to the dispute with China. And if you look at how the Trump administration handles its trade relationship with Europe, that's a perfect example, right? Anytime the president feels like he needs to vent a little bit, he's going to talk about European auto tariffs. It's going to be the same thing with China for the foreseeable future. There are definitely major structural issues that need to be addressed between the United States and China in terms of the geopolitics and in terms of the way that China has approached its accession into the WTO, its approach to intellectual property, and its approach to how foreign companies operate in its market. Those are things that need to be addressed. I don't think the Trump administration is ever going to address them. And as such, I don't think a clean resolution to the trade war, whatever that may be, is going to be something we see under a Trump presidency. And by the way, it might not matter who takes over next. We may not see a clean resolution of this dispute with the next president, regardless of which party they are.
Okay, George, really good stuff here. To bring this back into what it means for bonds, what it means for stocks, one of the things that we discussed here was that the nature of the extreme bond rally on the year to date had not there's a possibility basically that this had not all been about this, true expression, if you will, of economic risk. When we had this sharp sell-off a few weeks back, it seemed like there was some risk here to, if the economy does indeed continue to pick up and not get worse, that there's going to have to be some positioning recalibration. What do you guys see now as being the risk to the bond market? Does it remain that there's continued upside to bond prices as things get softer, or given everything we're saying here, some potential signs of bottoming, some potential signs of things not being as bad as people say in Germany and the U.S. being overall solid, is the risk here then to more downside in the bond market?
Given how big the move down has been, I think it's playing with fire down in yields, has been. I think it's playing with fire to say the risk is significantly lower in yields. And the reason for that is that we've already seen a significant activity response from rate sensitive sectors, especially housing, right? Housing was looking on rough end of cycle legs at the end of last year.
Yep.
All of the data was down and to the right. It was not looking good, whether it's new home sales, whether it's existing home sales, prices have decelerated, whatever metric you want to look at. Now is the complete opposite, with the exception of prices. Everything else is moving up and to the right. We're seeing big upticks in activity. So if 10-year yields remain at below 2%, if mortgage rates are around 3.5%, housing activity is gonna keep us out of recession, and that's pretty much the bottom line in the U.S. domestic economy. You could see headwinds from overseas in terms of manufacturing, but really those have already hit in a large sense, and U.S. manufacturing is still holding on pretty well. I think that if you had to pick between a sort of binary, where's the next big risk to bond yields, we would say the next big risk is upwards. And if bond yields are going to move upwards, that's not necessarily good or bad for equity prices on its own. What we would say is that it's going to have a significant impact on which companies are leading. If bond prices are going down, yields going up, then you're going to want to be in cyclical industries that haven't had a ton of momentum.
Yep.
Anything that's got a lot of momentum on a year-over-year change perspective, that's how a lot of these momentum indices work, is just as simple as what's up over the past year.
Yep.
That is going to be, by definition, very correlated positively to bond prices, because bond prices have had such a big move over the past year. So if you're looking for something that, to express in your equity portfolio the view that bond prices have probably topped out, yields have bottomed out, then you want to be in cyclically oriented sectors and stuff that isn't defensive. So anything but utilities, consumer discretionary, some of the more defensive telecom players, that sort of stuff is what you're going to want to avoid.
You guys had a great chart to wrap this up. Last thing here, George, last week showing the dividend stocks, the highest yielding dividend companies had done the best, up 7.7% on average for the month of September. If that is an expression again of investor expectations that rates only go lower and they need to pick up that yield from companies, is there a potential unwind, a little bit of what we saw before potentially here on the horizon then if there is a bit of a reckoning? I mean, last week the 10-year yield didn't really go anywhere, but it was utilities, real estate, staples, dividend stocks that were all up.
Yeah, well, high yield dividend stocks. So if you take the highest yielders, we would generally think of those as relatively more risky stocks or stocks whose dividend is at risk. And so, given the defensive move in the economy and interest rates over the past year, that's going to be a cyclical company. So, the very, very highest yielding dividend stocks are actually going to be inversely correlated to the performance of interest rates, right? Because if they're very high dividend, that means dividend yield, that means the dividend is probably at risk, or there's some sort of compensation that investors are demanding on a dividend yield basis for whatever idiosyncratic thing is affecting that company. As if that stock is typically going to move inverse to interest rates. So really, that was sort of the point we were making, is that the small uptick we've seen, very small uptick we've seen in yields since the lows earlier in September, that is sort of going to be driving those high dividend yield stocks to outperform on a price basis, as and other stocks, low PE, low price to book value, low price to sales value, however you want to measure that sort of value attribute. If interest rates are going up, those stocks are going to outperform, not only because they're correlated to the same things that are driving interest rates, but also because you're going to see flows into those kind of stocks because they've lagged so much the defensive stuff that's correlated to yields over the past year.